In Chapter 10, we look at budgeting. In our first example, we're going to create a master budget given information about production and sales of two components, C12 and D57. So we have a lot of information about these two components. And the first thing that we want to do is create our sales budget. So we need to create each one of the budgets. So we start with our projected sales in units times the price per unit. So our projected sales of C12 is 12,000 units. And our projected sales of D57 is 9,000 units. So all total, we have sales of 21,000 units. The price per unit of C12 is $150, and the price per unit of D57 is $220. So our revenues are units times price per unit and our total sales revenues, sum of those two together. From our sales budget, we create our production budget. So we start with our sales in units, and then we add our desired finished goods ending inventory. So our desired ending inventory is 4,000 pounds of 300 pounds or 300 units of C12 and 200 units of D57. So we add those together to get our total units needed. We then subtract our beginning finished goods inventory and that tells us how many we need to produce of each unit in order to meet both our sales projections and our desired inventory goals. Next, we need to work on our raw materials purchases budget. So we'll look at how much we need of each raw material to meet our production level, and then we'll determine how much it costs to buy those raw materials. So we start with our production level. So we're going to produce, that comes from our production budget. Next, we're going to look at each raw material individually. So we have raw material 1. We need the number of pounds per unit for each C12 and D57. So the number of pounds per unit for C12, 10, and for D57 is 8. We take our number of units times the pounds per unit to get how many pounds in total that we need. We're then going to add our desired ending inventory to give us the total amount of pounds that we need for production. So we have our desired ending inventory in pounds of raw materials. So raw materials, our desired ending inventory is 3,000 or 4,000. So our total needed for pounds, we then subtract our beginning inventory and that tells us how many pounds we need to purchase. Our cost per pound of raw material 1 is $2. So the budgeted purchase cost is the number of pounds we need times the $2 cost per pound. So we would do that same thing for raw material 2 and raw material 3. So we have the number of units we're going to produce, the number of pounds each, raw material 2, Once we finish our raw materials budget, we move on to the direct labor budget. We again start with the estimated production. And then we need our direct labor hours per unit. And we take our units of production times the direct labor hours per unit to determine exactly how many direct labor hours we need throughout the year in order to make our projected production. Our hourly wage rate, it tells us up here in the information that our hourly wage rate is $25 per hour. So we're going to take those hours times $25 to get our total direct labor amount. The next thing that we need to do is our overhead budget. So we have information about our overhead. We have indirect materials, miscellaneous, indirect labor, payroll taxes and fringe benefits, maintenance costs, and heat, light, and power. We also have information about our fixed factory overhead. So we have a variety of overhead expenses here, and we need to separate those out into what is our total, our variable amount and our fixed amounts. So variable direct material, indirect materials, Payroll taxes and benefits. Maintenance costs. And heat, light, and power. That gives us our total variable expenses. Now we need our fixed overhead expenses, supervision, maintenance costs, fixed, heat, light, and power fixed. So our total fixed amount, then depreciation, our total depreciation, and our total overhead. That moves us on to our budgeted cost of goods sold and finished goods ending inventory. So first we have our sales volume, which we take off of our sales budget, 12,000 of C12 and 9,000 of D57. Then we need to fill out these schedules to determine what our cost per unit is. So what is our budgeted cost per unit of C12? So we take our cost information, so how much does raw material 1 cost? $2, and we need 10 pounds. So our per unit is the cost times the quantity per unit. We don't use any of raw material 2. Raw material 3 is 50 cents, and we need to direct labor is $25 per hour, and it takes 2 hours. And now we need to calculate the variable factory overhead and the fixed factory overhead. So we go back up to this amount of information, and it says that overhead is allocated by direct labor hours. So we take our variable overhead amount here. So we're going to look at our schedule. We're going to divide our variable overhead amount by the number of total direct labor hours to get our variable overhead rate. We will do the same for our fixed overhead rate. So we'll take our fixed overhead divided by our total number of labor hours. Okay. It's 2 hours of labor for that unit. And we get a total cost per unit for C12 of $93.80. We then do the same for D57. So our cost of goods sold, cost per unit, $93.80 for C12 and $135.70 for D57. Take the number of units times the cost per unit, and that gives us our total cost of goods sold. Then we have our amount in ending finished goods inventory. So in our ending finished goods inventory, we wanted 300 of C12 and 200 of D57. We have our cost totals. And that is the total of our ending finished goods inventory. Then we have our selling and administrative expenses. This is similar to our overhead amount, where we just need to make sure that we pull down the right information from our problem information. So first, our selling expenses. Advertising, sales salaries, travel and entertainment, and our warehouse depreciation. Add those together, and those are our total selling expenses. Pull down our administrative expenses. And then the last thing we can do is create our budgeted income statement based on all of the information from our other schedules. So we start with our budgeted sales. Next, we would have our budgeted cost of goods sold. Gross profit, sales minus cost of goods sold. Our selling and administrative expenses, and that gives us our pre-tax operating income. Our income tax expense is 40%. So we take our operating income times 0.4, and our after-tax operating income is $472,860. And now we have completed a master budget and a budgeted income statement, which is also called a pro forma income statement.